Hello, I'm Tom Curran. I'm the CEO and founder of Curran Wealth Management. My purpose in speaking to you today is to discuss the economy, the stock market, bond market, as it relates to the war. The war is troubling. It certainly caused a lot of concern and consternation on the part of investors everywhere. The question, though, is what do we do? How do we behave? And I've often said that as an investor, it's very, very important to be invested in a way which allows you to know how you will behave, how you will react, what you will do before an event occurs, even though we don't know what that event is. That we have to always be prepared for the most unexpected of events. That's the way we try to be invested. I think that's the way we are invested. We say that we buy stocks for the long term. When you buy stocks with the idea that you will hold them for a long time, there's very little tactical planning that goes into it. If this, if that, then this will work really well in this particular company or industry group. We don't invest that way. We invest with the idea that we will find great companies trading at reasonable prices, whose expectation for us is they will grow their earnings over time, regardless of how the economy does. Clearly, if the economy does well, companies will do better. But we're not interested in finding companies whose fate is determined really by how well external events beyond their reach, beyond their control, impact how they'll do. We don't want to own companies like that. We want to own companies that will do well in spite of what goes on. So here we are confronting an economy that is facing a war unlike any we've seen or read about since World War II. The idea that a major nation can invade a neighbor nation with tanks, artillery, bombing cities is something that I think most of us have come to believe that just isn't going to happen. Yet it is happening, and it is impacting the market. What do we expect? Well, the wars generally are inflationary. They cause governments to spend more money. They tend to cause some shortages, supply chain issues like we're experiencing now. Prices go up. And what we have right now, though, is a war which is getting in the way of a previously stated policy on the part of the Federal Reserve to raise interest rates. Our economy is not stagnant. Our economy is not slowing down. Our economy is very much in gear. It's positioned to do better. The fear of interest rates going up had some of us concerned that it might slow the economy, in fact, force it into a recession. Because of the war, the Federal Reserve now, because of their concern about the fragileness that we all face with regard to war, those half-point increases that were being discussed not too long ago, those half-point increases in interest rates are not likely to occur. Which means, to accommodate the war, the Federal Reserve will probably move much slower in raising rates, trying to stall the economy than they would have otherwise. Is that good long term? Is that bad long term? Time will tell. But in the near term, it seems to us the economy has a better probability of improving as a result of the war than it would have had there not been a war. I know that seems perverse. I know it may not make any sense, but the stock market, in our opinion, is still poised to do well. What can we expect? We can expect volatility. We can expect all kinds of bad news to impact the way we feel and the way we act. But underneath all of that, we take some consolation in knowing that there is more money floating around available for investment, more money floating around in the economy available to be spent. And now that the coronavirus issue has backed off a little bit, we're seeing a robust growth in the service economy. That all bodes well for stocks. Now, what about interest rates? I spoke a little bit about those the other day. Inflation is the enemy of fixed income investors. Inflation is not good for the bond market. And as I've said before, inflation is a long cycle phenomenon. It's not likely to go away in the near term. We're going to have to learn to live with it. And that was what I cautioned everyone to be aware of the other day. We have to adapt to it. There is no long-term good solution to fixed income and higher inflation rates. So what are we doing? Well, we're looking at our various holdings. We are making some changes. We are, I think, in a very subtle way, increasing companies like Berkshire Hathaway. We purchased it, as you know, in our core growth strategy not too long ago. Berkshire Hathaway is a company that we've watched for many, many years. Never quite thought it had the suitability that we were looking for, but things change. And so we've added to Berkshire Hathaway. We've actually bought it twice over the last month or so. So we are making subtle changes in our portfolio to adapt to an inflationary environment in the stock market. Are we going to make wholesale changes? We don't see that happening. But we do see some subtle changes that we are making as a result of what we're experiencing now. I might mention to you that back in the throes of the financial crisis, we made changes back then that were subtle at the time, continued over time. It's the period when we bought Google. It's the period when we bought Apple. It's the period when we bought other growth companies that we continue to hold today in today's market. We're making changes that remind me of those changes that we made, where we didn't really compromise our core philosophy. We basically tweaked it. We were looking to enhance it, and that's what we're doing now. So we remain cautious about inflation and interest rates and the bond markets. We're prepared, we're positioned to benefit from higher inflation in our fixed income investments. It's not a nice position to be in, but I think it's the only one to be in. We're positioned to take advantage of future growth in the stock market. And as I want to say to you, as I've said before, what we don't expect to change in is inflation rates and interest rates. We expect both inflation to stay high, maybe not as high as it is now, but to stay high, well above the average of the last 100 years, which is about 3.25%, well above that. And we expect interest rates to begin to rise. So our outlook is, while we're in for a very volatile period, we can have good days, we'll have bad days. Our outlook continues to be that we will get through this. The markets will adjust. Maybe most importantly, our view is that the war in Ukraine will be resolved sooner than later, and that we'll begin to find some normalcy